So where do you start when it comes to getting your first buy-to-let mortgage? My name's Sam Norris. I'm the property investors broker and owner of Grand Union Finance. And on this video, I'm going to talk you through some of my tips for getting your first buy-to-let property and your first buy-to-let mortgage. Property is about patience. Hi guys, welcome back. Today we're talking about buy-to-let mortgages, as I said. But before we kick off, please don't forget to hit the subscribe button and the notification bell so that you get told whenever any of these new videos come popping up. Twice a week we do them. And also please give the video a thumbs up. It helps get my message out to more people. Now, let's talk buy-to-let mortgages. I get inundated with messages on a weekly basis from new investors saying, Sam, I want to get into this property game. Where do I start? Now, the place to start is knowing that it's something that you want to do. The next thing is obviously identifying what your strategy is. Now, when we look at buy-to-let mortgages, we tend to look at two separate ways of doing this. It's either that you will save up a deposit, probably about 25% of the value of the property, and then get a buy-to-let mortgage of 75% of the property's value to actually purchase the property with, and then you can rent it out and make your net cash flow on a monthly basis. The other way of doing it is to use a buy-to-let mortgage as a remortgage once you have already purchased a property, renovated it to raise the value, and then you would then get a remortgage on the property to recycle cash. We call this the buy, refurbish, refinance model. And when you purchase the property in this strategy, you'll either buy it using a bridging loan or using cash, which obviously means that when you come to refinance, it's based on a higher value. You then pay off the bridging loan, pay back yourself as much money as you can in terms of what you've put into it, might be deposit, cost of the works and the fees and things like that, and then you have a pool of funds to go and repeat that process. And it's a way of which you can increase your portfolio very, very, very quickly. But let's go back to basics when it comes to buy-to-let mortgages. Buy-to-let mortgages, as it says in the title, are mortgages that you will use when purchasing properties that you are going to rent out. You can't rent out a property that you have a residential mortgage on unless you have prior consent from your lender. So on the whole, you're going to need to use a buy-to-let mortgage, and they are more specialist. There are lenders that will lend at relatively low rates. Usually they will lend to those that buy property in personal name, and they'll lend them at relatively low rates. Their rental stress tests will be quite strict, and their loan to values will probably be about sort of 60 to 75% maximum. Now, there will be other lenders that are a bit more specialist that will lend to limited companies, because lots of people buy property in limited companies to take advantage of some of the tax efficiency that you can do or can take advantage of when you do that. They will lend to potentially first-time landlords, whereas others maybe won't, that are a bit cheaper. They will lend in more difficult or unusual circumstances. Maybe you don't own your own home. Perhaps you it's a quite small property in terms of the value, quite a low value, and they will also have a much more flexible rental calculator. So these are the things to consider when actually going and purchasing your first property and thinking about the kind of lender that you're going to use. But let's talk about some of the things that I've just mentioned there. First and foremost, one of the most important things that you need to be aware of with buy-to-let mortgages versus residential mortgages is residential mortgages are worked out based on your affordability to repay the monthly mortgage payments, income and expenditure, surplus income, and do you have enough to cover those payments? Now, a buy-to-let mortgage is not going to be based on your personal affordability to be able to make the monthly payments. It's going to be based on the rental income. Now, the standard way in which we work out how much you can borrow based on the property's monthly rental income is using something called a rental calculator. And different lenders will have different rental calculators Some are going to be more flexible than others. So in certain areas where the yields aren't particularly good, it does mean that we can potentially look at still getting the loan amount that you need, even when the yield isn't too good. So places like London and the southeast, where yields are usually sort of 2 to 4%. Sometimes it can be quite difficult to get to 75% loan to value versus properties in maybe South Wales or the north of England, where rental yields might be sort of 9 to 11% potentially. So it's something to bear in mind. But typically, rental calculators will work out the monthly interest payment that needs to be made on a particular loan size, stress tested at a higher interest rate than the one that you're actually paying. So you might be paying 3% and they'll stress test it at 5 or 5.5%. And then whatever that monthly payment will be, the rent will need to cover a certain amount more than this. Usually this is something like 125% to 145% of that figure. Now, those of you that can run figures pretty quickly in your head will probably know that your yield needs to be pretty high if you need to cover an amount that is stress tested at 5.5%, and then the rental amount needs to be 145 times that monthly interest payment. Which is why some lenders will offer a more flexible stress test, where they might be looking at, say, they'll look at the pay rates or what you're actually paying instead of stress testing it, and it might look at only 125 times. So if you're a standard rate taxpayer, basic rate taxpayer, you're getting a a limited company buy-to-let, or you're looking at a 5-year fixed rate, these are the usually the ways in which we can get more flexible rental calculators. So that's something to bear in mind. So the rental calculator, and understanding that, is probably one of the most fundamental things that you need to know when it comes to getting a buy-to-let mortgage. Now, the next thing really is when it comes to your personal situation. Now, as I said before, lenders don't look at what your personal affordability situation is when it comes to deciding how much they can actually lend you. It's all down to the rent. But a lot of lenders will have what we call minimum income requirements. And basically, this is something that they've determined in-house as a way of deciding who they believe is going to most likely have enough surplus to be able to cover any potential rental voids and still make sure that those monthly payments are met. So typically, if you earn and can prove that you earn more than £25,000 per year, generally you're going to be okay with most lenders. There are some lenders that will have a minimum income requirement of 20,000, some that have a minimum income requirement of 15,000, and there are others that don't have a minimum income requirement. This is very, very important, because a lot of people seem to get confused on this point. Because a lender doesn't have a minimum income requirement does not mean that they don't have an income requirement. So they still need to see that you have some kind of income, and they will make a decision as to whether they think that it's enough to potentially cover void periods should they happen during the course of their mortgage term. Generally, if you're on a 12-month assured short hold tenancy agreement, put my teeth back in, you're potentially going to have, if you're going to switch tenants once a year, you may well only get 11 months potentially worth of rent, because you might have a month out where you're trying to find a new tenant, for example. And lenders just want to make sure that you can cover that sort of amount, and they'll have ways of working that out, internally with their underwriting to figure that out. So they're two of the main things that you need to worry about. Now, one of the other things that we come across is first-time buyers and first-time landlords. Now, generally speaking, lenders like to see before you're going out and buying a property that you are going to rent out as an investment. Generally, the consensus is that lenders want to see that you own your own home. Now, you could look at this from 2 points of view. From one school of thought might be, well, why do I need to own my own home in order to invest in property? I tend to agree with you to a certain point. It is pretty daft when you could go out and buy £100,000 worth of shares, for example, but if you wanted to buy £100,000 property and borrow against it, it's you have to suddenly own your own home. I suppose it all comes down to the fact that you're borrowing money against it, which is actually one of the reasons that lenders say that they want to see that you own your own home, or you own another property at the very least. They want to see a track record of you being able to pay a mortgage on time. Yes, of course, they can look at your credit score and your credit file and to see if you've got any other debt or credit that you are covering on a monthly basis, so that you've built up, a good track record there. But nothing really beats paying a mortgage. So realistically, guys, for those of you that are watching, if you're not a homeowner or don't own any property at all, your lending options are going to be restricted if you're looking to buy your first property as a buy-to-let. But it's not to say that it can't be done. One way of getting around this is to follow that buy, refurbish, refinance model that I mentioned before. Some lenders offer what we call a bridge to let product, and what that means is that you can buy it with a bridge and your exit is guaranteed. They themselves, the bridging lender, will offer you a buy-to-let mortgage once you have completed the renovation work to the property. And so this will actually allow you to, although the rate that you're going to get is going to be more expensive, it will allow you to get on the ladder or start your property journey, so to speak. So this is something else that's worth considering. However, if you're going to go straight into a mortgage and you're not going to do any work and it's just going to be what we call a turnkey investment, you are going to find that your lending options are a little bit restricted. But don't worry. This is just going to be for the first property that you buy. And if you look at it, maybe a 2-year fixed rate, we can look at refinancing that in 2 years' time onto something that's much, much better. So guys, this was meant to be a real just basic intro into some of the things to consider when it comes to buy-to-let mortgages. I really hope this has been a helpful video to you. As I said before, if you've just come across the channel and you haven't seen any of my videos before and this has been helpful, it might be worth subscribing and hitting the notification bell, because I put out 2 videos on property finance every single week, whether it be bridging finance, development finance, more complicated HMO mortgages and serviced accommodation mortgages, all the way down to the basic stuff. So definitely worthwhile subscribing and checking through some of those. You can also go and follow me on various other social media platforms. I'm on Instagram at the Sam Norris, Twitter at the Sam Norris, TikTok at the Sam Norris. You can find me on Facebook, Sam Norris Property, and you can also listen to my podcast, which comes out every Thursday morning, the Game of Loans podcast. All those links are actually in the notes to this video below, so go and check those out. Guys, thanks ever so much for staying all the way to the end. I really appreciate it. And if you have enjoyed this video, stick around for the next couple of seconds, because a recommendation for another one is going to pop up any second now. But for now, thank you very much, and I'll catch you on the next video. Bye.